Imagine a game where the rules are written in a language you don't speak. Where the points you earn trigger the same chemical in your brain as a drug. And where the house has spent billions of dollars studying your biology to ensure you never, ever leave. You think you're just buying groceries or just building credit. But you aren't. You're a participant in the most sophisticated psychological experiment in history. Most people think credit cards are a financial tool. They're not. They're a behavioral trap designed to strip you of your wealth while making you feel like you're winning. Welcome to Arc Finance. Most channels will tell you to pay your bill on time. But that's just level 1. Today, we are deconstructing the credit card arbitrage. We're going to learn how to exploit the biology of spending, how to use the float method to earn interest on money you've already spent, and how to hack your credit score using the 15/3 rule. To beat the bank, you first have to understand the weapon they use against you, which is known as pain decoupling. In 2008, researchers discovered that when you hand over physical cash, the insula, the part of your brain that processes physical pain, lights up. Lending cash literally hurts, but when you swipe a card, silence, the pain signal is severed. This allows you to spend more without feeling it. But it gets worse. Every time you swipe, a wealth transfer takes place. Merchants pay a 3% fee to the banks for every card transaction. To cover this, they raise prices on everything. If you pay with cash or debit, you're paying the credit card tax but getting zero benefit. You're subsidizing the first-class flights of the wealthy. So, how do we flip the script? We use a strategy banks use against each other every day, the float method. Most people think a credit card is for borrowing money you don't have. That is a poverty mindset. The wealthy mindset sees a credit card as a 0% interest bridge loan. Here is how this works. Every credit card has 2 key dates, the statement date and the due date. The gap between them is called the grace period. Let me explain the math, because this is where the banks catch you sleeping. Imagine your statement date is the 1st of the month. If you buy something on the 30th, the cycle closes the next day. You get a bill immediately, and you have to pay it in 21 days. That's a short loop, but watch this. If you wait just 48 hours and buy that same item on the 2nd of the month, right after the statement closes, that charge enters a brand new cycle. It sits on your card for 30 days before a bill is even generated. Then, once the bill is generated, you get another 21 to 25 days to pay it. 30 days of the open cycle, plus 25 days of the grace period. That is 55 days of free liquidity. For nearly 2 months, that cash stays in your high-yield savings account, earning interest for you, while the bank waits to get paid. That is the definition of leverage. That is 55 days of holding onto your cash, interest-free. During those 55 days, your cash shouldn't be dead in a checking account earning 0.01%. It should be sitting in a high-yield savings account or a money market fund earning 5%. You're performing interest rate arbitrage. You're taking a 0% loan from the credit card company, investing it at 5% risk-free, keeping the spread, and then paying them back on the exact due date. Is this going to make you a millionaire overnight? No, it might only be a few $100s a year, but that isn't the point. The point is the identity shift. A consumer pays the bank for the privilege of money. A banker charges the bank for the privilege of holding their capital. When you execute the float method, you stop being the victim of the system and start being the architect of it. Now, let's talk tactics. Which cards do you actually need? Stop watching top 10 cards videos where influencers hold up heavy metal cards just because they get a referral bonus. You don't need a wallet full of annual fees. You need a system. We call this the Triflex protocol. Card 1, the foundation, the catch-all. This is your boring, reliable workhorse. You need a card that pays a flat 2% cash back on everything. Why 2%? Because the standard 1% back offered by most banks is a joke. Inflation averages 2 to 3%. If you are earning 1%, you are technically losing purchasing power. This card is your default setting. If a purchase doesn't fit a special category, you use this. No thinking required. Card 2, the multiplier aka the lifestyle card. This is for your variable spend, the fun stuff. Dining, travel, and entertainment. Banks fight hardest for this category, so they offer the highest multiples. You should never accept less than 3x to 4x the points here. This is the card that pays for your vacations. You swipe this at dinner, at the hotel, and at the airport. Card 3, the sniper, the category killer. This is for your fixed spend, the bills you pay every month to survive. Groceries and gas. There are cards specifically designed to lose money on these categories to get you in the door. They offer 5% back. Usually, these cards have a cap, like $500 a month, but that is perfect for gas or groceries. The strategy is simple. You use the sniper for your needs. You use the multiplier for your wants. And you use the foundation for everything else: insurance, medical bills, random Amazon purchases. By doing this, you guarantee your effective return rate across your entire life is above 3%. You aren't coupon clipping, you are optimizing your cash flow. But having the cards isn't enough. You need the score to back them up. To get an 800+ credit score, you need to understand reporting dates. Here is the 15th rule to hack the algorithm. Most people wait for the bill to arrive to pay it. Wrong. By the time the PDF bill lands in your inbox, the bank has already taken a snapshot of your high balance and sent it to the credit bureaus. Even if you pay it off instantly, the bureau thinks you are high risk for that month because your utilization was high on reporting day. To hack the system, you must act 3 days before your statement closing date. Log in and pay your current balance down to $0 or leave a tiny $10 balance. Why 3 days? Because it takes time for the ACH transfer to clear. When the statement date hits, the bank takes their snapshot. They see a $0 balance. They report 0% utilization to the bureaus. Your score skyrockets. Then, the statement closes. If any pending charges cleared after your snapshot, you simply pay those off on the actual due date, approximately 15 to 20 days later. 15 days before the due date, 3 days before the statement date. 15th rule. This system is powerful, but it has one fatal flaw, and that is human error. The banks know you are busy. They are betting on you forgetting. If you miss one payment by 30 days, your score drops 100 points, and the interest wipes out a year's worth of rewards. This is how the house wins. Here is the ARC protocol. We do not rely on memory. We rely on systems. Log into every card account and set up auto-pay for the minimum amount. This is not your payment strategy. This is your fail-safe. This is your insurance policy. If you get hit by a bus, or get locked out of your account, or just forget, the minimum payment clears automatically. You won't pay a late fee. You won't get a missed payment mark on your report. Then, you manually pay the statement balance in full every month to avoid interest. The auto-pay protects your score. The manual pay protects your wallet. Finally, remember the most important rule, which is asset protection. I want you to take your debit card, put it in a drawer, and never touch it again. Using a debit card is an act of financial recklessness. When you swipe a debit card, you are unlocking the vault to your actual life savings. If a hacker skims your card, they drain your checking account. Your rent money is gone. Your grocery money is gone. You have to fight the bank for weeks to get your own money back while your bills bounce. But when you swipe a credit card, you are spending the bank's money. If a hacker steals your card and buys a TV in Paris, you get an alert. You click fraud. You don't lose a cent. The bank loses money. It is their problem to solve, not yours. A credit card is a firewall. The wealthy identity says, I never expose my own capital. I spend the bank's money, keep my cash safe behind the firewall, and settle the bill on my terms. The credit card game is rigged. It is designed to harvest your wealth 3% at a time and keep you on the hamster wheel of minimum payments forever. But just because the house always wins against the masses doesn't mean they have to win against you. You win by refusing to be the rat in the cage, pressing the lever for a dopamine hit. You win by understanding the biology of your own brain and overriding the insula with logic. You win by taking their tools, leverage, float, and rewards, and using them to build your freedom, not theirs. This is the fundamental shift. Don't be a consumer. A consumer eats what is served. Be an architect. An architect designs the life they want to live. I'm Arkan, and this is ARC Finance. Let's build your new reality.